Good afternoon, everybody. This is Michael DeGioia from the Affinity Trading Institute. Thank you for joining me. And what I'd like to talk to you today about is our 1-hour trading program, trading and fading gaps. So 1-hour trading, trading and fading gaps. This is the Affinity Gap Trading class. And I founded the Affinity Trading Institute, amazingly enough, going on 10 years ago. And this technique is a technique that I've been using to trade, surprisingly going on 17 years. It sometimes scares me how old I've become and how long I've been trading. So with that being said, this would not, of course, be a trading seminar without the standard disclaimer. So stock trading is not suitable to everybody. No representation in this presentation. No representation in this presentation is expected for you to take as a given. Nothing is likely to reproduce the same kind of results. All trading seminar attendees assume all risk. And obviously trading and investing can result in large losses and may not be suitable to everybody. However, with that being said, if you are trading using these techniques, you're probably better off than most. The techniques that are displayed here are for educational purposes, and they're to teach you a style of trading that is viable and has some real specific benefits to it. So let's talk about what's covered in our gap trading course. The Affinity Gap Trading course, we of course have a very brief introduction. We cover types of gaps. We go through our gap grading system. We go through entries, gap variations, targets, maximizing your profits, and then of course refining the trading process. So let's just first real quick cover what a gap is, okay? In the equities market, a gap is a stock that opens up at a price that is different than it closed the day before. The market is open from 9:30 a.m. and closes at 4:30 p.m. Eastern Standard Time. On any given day, hundreds of stocks show a gap in their price. It means they close different than they open. When stocks gap, no trader has a chance to get in or out of a position. Not necessarily true. I mean, obviously there is the pre-market and the post-market. So there is a little bit of viability there that you can get in at the pre- and post-market prices. Now, I'm going to just say, why we trade gaps. Okay, I like to personally start trading. I get down to my guess most of the time or before 9 a.m. But if I started at 9 a.m., this is why we call this the 1-hour trader. We started at 9 a.m. and started looking for our gaps. Okay, we have a half an hour worth of research time. At 9:30 a.m., the market opens. Okay. At 9:33, we mark our 3-minute highs and lows. There is a 1-minute high and low. And I'm going to talk a little bit about that, but I'm not going to cover it in too much detail. Okay, that's for you to actually take our full class, our gap trading, 1-hour trading class. At 9:35, we mark off our 5-minute highs and lows. Okay? That usually is our first indication of a trade. And I'm going to give you some, some examples of which that I've watched. I could show you. At 10:30 a.m., very often we are done for the day. Okay, very often we're done for the day. Then what we look for, if we want to continue trading, or in some instances, we haven't made our money for the day. Very often what we're looking for is the 10 o'clock to 10:15, which is called the first reversal time. Okay, we look for the trend trade or check mark play. And I'm going to cover that very briefly here. But before I go too far, I'm going to keep coming back to this slide because I think it's very, very important for our free class for you to understand that first gap trade, the 5-minute high and 5-minute low concept, and of course the check mark play. But before we go too far, we're just going to explain why do stocks gap. And it's very, very important because we are going into a specific kind of season right now. We go into that season 4 times a year. It's earnings season. Earnings are the best, in my opinion, the best kind of gaps, the most readable kind of gaps. So why do stocks gap? News, events like new products, management changes, lawsuits, or other announcements, okay? That's a big reason why stocks will gap, okay? The best gap, in my opinion, are earnings and guidance, okay? Now, why do we like earnings and guidance so much? We like earnings and guidance because they are not gaps that we cannot plan for. They are gaps that we can totally plan for. I'm just going to bring up this sheet. This is an earnings announcement sheet. I'm just going to bring it up and show it to you. This is from briefing. Okay, guys, I'm just going to bring up, this is an earnings calendar. I don't know if this is displaying well, but this is my briefing login. I'm just going to go to my earnings calendar. I'm just going to show you where I get some of my best gaps. So today we had only 3 stocks announcing earnings, but I want to show you what happens as we go towards October, because October, the week of October 5th is the official start of earnings season. Okay, the stock that we watch first once we get into the heat of earnings season is Alcoa. Alcoa's earnings come after the close on October 8th, 2015. Okay, so what happens is every one of these stocks, okay, the ones that are before the open and the ones from the previous night after the open, those are stocks that are viable gappers for the next day. So this is the most likely source of me getting gappers, okay, stocks that are going to gap is from earnings. And as you can see, there really is virtually no pause in earnings, meaning one earnings season flows into the next. So you can see that even the week before the official start of earnings season with Alcoa is you have Paychex on the 30th. You know, most of the big companies aren't really there. I don't see anything that's too. Barracuda Networks is fairly small. You know, this week we have really nothing big except I think Paychex is one of the next week is one of the big ones. Lennar was one this week. That was a great one, which I'm going to bring up as one of our examples. That was from Monday. That was an earnings reversal, which is a variation of a gap play. Okay, Nike, okay, which is coming up tomorrow. And we got BlackBerry and Finish Line, which is coming up on Friday. Friday tends to be a tough day for us to trade gaps on. FUL was one that we looked at today, and I'm going to talk a little bit about these as well. Okay, so why do stocks gap? Basically, earnings are the best kind of gaps in my opinion. Okay, we also have geopolitical events, so that'll gap the entire market. So sometimes you get sympathy gaps, other stocks in the same industry. And I'm going to show you another great place for gappers. And I'm just going to go, it's right on that same earnings calendar. Let's go to calendars, upgrades, and downgrades. Okay, so we got Skyworks. These are upgrades. These are downgrades. Okay, so those will be some movers for today. Okay, just from the upgrades and downgrades. So upgrades, downgrades, and then we have our earnings calendar. Sometimes stocks gap for no reason at all. Those are great gaps to fade because there's no real catalyst behind the gap. So when do gaps occur, right? So all gap analysis begins on the daily chart, and that's pretty much where the direction of this presentation is going to go in a few minutes, is doing some daily analysis. So the time to analyze the gaps is before the open. Many good gaps begin their move in the pre-market. Seeing the gap is a visual thing. It's not a dollar amount thing, not a percentage thing. It's more of a visual thing. It's gapping into resistance or gapping down onto support. Gaps that overlap, okay, a prior price bar are harder to see than a gap that leaves a void on the daily chart. Okay? The voids are visible. They're open windows for us to take a look at on the daily chart. They're very easy to identify. But there are gaps that end up fading, therefore overlapping the prior day's daily. And I'm going to show you a few examples of that as well. And then there's also, where do we find gaps? By the way, I showed you briefing.com. Okay, we have there are some trading scanners. Okay, things like Trade Ideas. You got your own platforms, high-low list. I'm going to show you how to do it on the platform that I use, which is called TurboTick, and I'll show you how I use the high-low, gainers and losers list on TurboTick. And for the most part, though, I like Briefing, that free briefing investor service. I like free. I always say if it's free, it's for me. Trade Ideas is a paid service. The Affinity Legends of Wall Street Trading Room is a paid service as well for our members. And then if you're using a trading platform, your trading platform usually has a very simple tool for you to find gaps on, and I'm going to show you how to do it on TurboTick. The other thing to do is you got to know what gaps to exclude as well. So the gaps to exclude are stocks that are trading ex-dividend. The dividend has come out of the stock, therefore they gap because they just are paying a price of their stock. Part of the price of the stock is being paid out to the people who are the investors on record. American depository receipts gap because they're traded on foreign markets. Okay, foreign markets, American depository receipts, they're going to gap because the stock is trading in another country, and I'm going to show you an example of that. Other gaps that you should avoid are cash buyouts. If a company is buying another company, then it's a cash buyout. Sometimes secondary offerings, okay, when the price is public knowledge, you want to avoid those gaps as well. Sometimes you may want to trade them, but it's a different kind of trade. And stocks that split, they don't act like gaps because the price really isn't changing. It's just being traded at a different multiple. Okay? So those are some very, very basics of gap trading. Now I'm going to jump to our whiteboard. And we're going to talk a little bit about what I have here on the screen here, which is our method, trend, pattern, trigger, stop, target. Delete this. Okay. So what I want to show you is the three things that can happen each and every day. And I'm just going to do it on a very, very simple basis. And this is where our daily analysis starts. Okay, and I'm going to bring up another stock chart as well. I just want to bring this one up. Guys, this is the stock Lennar. Okay, I'm just going to move it down a little bit so you can see the name of the company. Okay, this is Lennar. Does everybody see that? Lennar. Now I want us to go very, very specifically to the earnings calendar because I like to do this on a very specific basis for a specific example. And by the way, guys, I would like to say that on this one, I watched this and I really should have traded it, but I didn't because I watched it. And you know, sometimes it's hard to pull the trigger, right? You watch it, but you can't do it. And the only way you learn to do it is by really getting it down pat. So really Monday before the open, Lennar came out with earnings. So this is an example of an earnings gap. So Lennar, Monday before the open, has a gap because of earnings. Okay? So today is the 23rd. Today is the 23rd. Okay, so you can see there's today. There's the 22nd. Okay. There is the day of the gap, the 21st. So this was Friday's daily bar, and Lennar gaps down. Okay. It gaps down, rallies up, fails, rejects, breaks the daily low, triggers down. Next day, gaps down even bigger, gap and go down. That was on Tuesday. Okay, which is another concept, which is sometimes the day after the gap follows through. And this was on Lennar, L-E-N. Okay, but I'm going to talk a little bit about this gap because this has a very big rejection of that green bar. That's called shock value. That the green bar that everybody closed on Friday was completely rejected and reversed on Monday morning. There was some residual buying, but only short term until it sold off and went lower. The result was gap and go down. Okay? So that's Lennar. Okay, very, very, a very, very interesting chart and case study for us to take a look at. And we traded it in our online trading room, the Affinity Legends of Wall Street trading room. All right, so without too much further ado, I'm going to go on to the and talk about some of the daily chart action and how we look at what the market can do each day. There's only 3 things that the market can do each day, and in the instance, I'm going to use the instance of Lennar as an example of what happened and how we would play that gap, or a Lennar type example. So on a bullish day, let's say you have a big bullish bar up. So this is, let's just say, Friday. Okay, we have Friday. Okay, that would be Thursday. On a big bullish bar up, maybe even a little topping wick. Okay, that's everybody's going long on Friday thinking that this stock is going higher into, let's say, earnings pre-market on Monday. All right? There's only 3 things. Now this is where I kind of go off the Lennar example and just start going into the 3 things that the market can do each day. You can either gap down, open flat, or gap up. Okay? So there's only 3 things that can happen as a result of that daily chart from Friday. You can open down, open flat, or gap up. Now, if we gap up, this is an easy trade. Right? We gap up, easy trade. My stop is above here. Okay? Most likely the stock trades down. I have a very, very tight stop. Okay, this is called a novice gap, which I'm going to cover in about 2 seconds. Okay, we expect it to fade. So the first move would be a fade. Okay, and then when we get down to here, we get to fill. Okay? Does everybody see that? Fade and then fill. Now the next one is, okay, we open flat. If we open flat, we give it more time. So that's the old open flat expression is you give it more time. If you get a flat open, the if-then statement is to say, okay, give it 30 minutes. Okay? So the flat open, okay, give it more time. Okay, and the amount of time that we would allot is 30 minutes, 30-minute rule. Okay, it means you give it 30 minutes on a flat open. Just sit back, find the stock that's not adhering to the flat open, and try to play that one. Okay, so that's what you do if there is a gap up. Now, by the way, this would be your stop area. Stop area. Okay. By the way, what happens if we gap up past resistance? We gap up past resistance. We say it's a possible gap and go, right? And then we say gap and go. Okay? So that's what happens, possible gap and go if we gap past resistance. All right? Now, what happens if we gap down? Okay, if we gap down against this. If we gap down, then we call this one, this is another play that we have a name of. Okay, the gap down would cause us, it's called a bear gap surprise. Right, so gap down would be a bear gap surprise. And what would potentially happen is we could rally, okay, and then sell off, right, when we hit that gap, fade, and fill. Okay, and then this is kind of the reverse check mark. It's bearish. So this is the bearish direction. And then this is the fade, right? This is the bearish direction. And this is the fade, which is the bullish direction. Okay? So we have the bearish direction and then the fade, which is the bullish direction. Okay? So that's the bear gap surprise. Now we also call this is the inverse check mark. This is the inverse check mark play. All right, and that's for the bearish gap down. Okay? Now, what happens if we gap way up? Okay, we would be doing the bullish check mark play, and I could show you what that looks like. I'll show it to you down here because we're a little bit too I'll show it to you down here because we're a little bit too we ran out of space here on the screen. So let's just say this was resistance, but now we gap way up here. Okay, so this was resistance. We gap beyond resistance. Resistance. So we gap beyond resistance, and then we get the bang check mark. Okay? So the initial move is a bearish short, which is a fade. Okay? And then this next move is the trend play, okay, after the fade. So this is the fade. Fade. And then this is the gap and go. Okay? Now, the most ideal example of a gap and go is it doesn't go down that much, goes sideways, and then goes higher, which would be a typical standard gap and go. Very little negative price action. And there we go. Okay? And we just go higher. Okay? So those are the variations, okay, that can happen. By the way, guys, if you get a gap, fade, and fill, and it continues to go down, it can turn into something called a gap and crap. So very often these gap plays lead into each other. So the gap fade can turn into a fill, can turn into a gap and crap, okay, can turn into a bear or bull, actually it would be a bull trap, okay? So very often, what I like about gap trades is that they can very often just continue going and going and going and going, okay, in both the bullish and the bearish variation. That's a lesson for another day if you take our class. Okay? So this is where a good trade starts. A good trade starts at extreme levels from the daily. Okay? Near support or resistance. We try to find confluence of indicators. Okay? The more the merrier. The daily level is confirmed by the intraday pattern. We want to make sure that the intraday has clear air. Okay? That way you know what to expect out of the move if you take the trade. Take the money while it's there. You want to make sure you're using good risk management, which is something we cover heavily in our foundational and advanced classes. Okay? You can make your day fast in gap trading. Then the key to gap trading, which is the whole 1 hour trading method, is I found that I made most of my money in the morning, and very often I would lose it as I continued to trade. So you make your money fast, shut down to keep your day. Shut down to keep your day. Remember, the markets, okay, and traders and sectors, stocks are like pack animals. They move together. You do need your risk management approach before you enter every trade. I'm going to cover this N in a second because there's a beautiful one that I saw that I want to show you, but I'm not going to cover it in too much detail. That's for another class. All right, so with that being said, I'm going to just delete this. Okay, so we're going to delete this, and I'm going to get going on the bearish variation. So the prior day is down. Okay, so this is, let's just say this was, Thursday. This is Friday. Okay, and then we get a gap down on Monday. And this would be, there's only 3 things the market can do, right? You can gap down, Open flat or gap up. The gap down is called a novice gap. The open flat is the 30-minute rule. 30-minute rule. The gap up is called the bull gap surprise. Okay, bull gap surprise. So those would be the three things. So this is a novice gap. This is a type of pro gap. Okay, this is a flat open. Novice gap would be the setting up for the gap fade. Okay? Now, by the way, if the gap is down here, we would expect a gap fade. We would expect the gap fade to come up. Why? Because this is support, and then we would expect a check mark down. If it breaks support, then we expect it goes to fill, from fade to gap fill. Gap fill. Okay? So from gap fade, then we'd expect it to gap fill. Okay, now on the 30-minute rule, we're not going to talk about that too much. We know we just watch it for 30 minutes. Okay? If we do the bear gap surprise, we watch for a divot down and then to go back up. That would be a check mark. If we start to go immediately, then that would be a gap and go. Okay? And those are the possibilities based on this. All right? So that would be the bearish and the bullish variation of the same plays. And notice they are all if-then statements. If one thing happens, then the other thing will happen. Okay? So, without any further ado, I'm going to go back to my desktop sharing. I'm just going to cover what a novice gap is. Okay? So there's lots of different types of gaps. Okay? Types of gaps. Common gaps. They're generally not interesting. Continuation gaps continue the direction of the current move. Novice gaps end the current move. We look for gaps that fade, like oversized gaps that then fade and then sometimes fill. Professional gaps begin a new move. Supersized gaps are gaps that are so big that gap analysis just isn't useful. Okay? So, I've covered everything that I'm supposed to cover for the 1 hour trading and fading gap introduction. So now what I want to do is I just want to show you some individual charts that are good examples of gap fades and various different gap strategies. So just give me 1 second as I bring up my chart. Guys, a great little free research, a great little free service is called TradingView. Another, if it's free, it's for me. Hopefully it comes up. I'm not going to look at the, I'm going to look at Lennar, L-E-N. And I want you to see that on L-E-N, I really want us to focus in on this particular chart. Okay, so we have today, which is Wednesday. This is Tuesday. That was Monday. Okay, we gapped up on Monday, but we gapped into resistance. We went up a little bit, and then we sold off. The gap faded, then filled. Okay, so we gapped from down here all the way up to here, faded, then filled, then broke the low, so we enveloped that entire day, broke down, bounced back at the end of the day. The next day we gapped down, which is a continuation gap, and then we fell all the way down to support. Now I just want to go and bring up a different time frame here. I'm just going to bring up the 15-minute chart. So here we gap up. Just going to bring it back a little bit. We gap up into resistance. We fade. Then we fill the gap. We sell off, break the low. We bounce back up to what was support is now resistance. We gap down. We break support. We continue down. Great example of gap fades and fills, as well as so guys, this is a gap fade, fill, and then continuation down. This would be a great example of one of the trades that we call, it's called an earnings reversal. So it gaps up on earnings and then completely reverses down. Let's bring it back and look at this from a 5-minute perspective. Now the other thing, by the way, the indicator that we have on here is the VWAP indicator. We watch it as it crosses VWAP and goes lower. So here we have it gap up. It's trading right at the VWAP, and then it obviously trades down and goes lower. That's the next day when it trades off even lower than that. The reason it looks so spotty is this service is just using BATS data, which is not the complete set of market data. Okay, now I want to just bring up one more example. Okay, that's the QQQ. And I'm going to bring it up on the daily. Because you can do this exact kind of analysis on the markets as well. Okay, so here we have a gap down. We break the 5-minute low. I'm just going to move this a little bit. We gap down, we break the 5-minute low. This is the low established on the first 5 minutes of trading. You'd put your stop above the 5-minute high. You see it trade down. It hits into a daily support level. Okay, I'm going to bring up my daily just so you could see that there is a daily support level. I'm going to just put in a trend line. Okay, so there is our daily support level. So we gap down, break the 5-minute low, hit into daily support, the trade is done. Okay, hopefully we take our money and run. Done for the day. So there is our daily support level. So we break the 5-minute low. Okay, break our 5-minute low. Where would we put our stops? Above the 5-minute high. Okay, could we be a little bit tighter? Sure, we could exclude the wicks. Problem with doing that, okay, is that you might get stopped out. If you exclude the wicks, it's possible that you could get stopped out because the stop out would be up there. I'm going to show you an example from today, which was INTC. By the way, it was a tough one to trade. Okay, INTC gapped up into resistance. Okay, We could look at it on the daily first. Okay, on the daily, we gap up into resistance from the daily. Look at it on the 5-minute basis. We short the 5-minute low. Okay, put our stop above the 5-minute high. Oops. Okay, stop above the 5-minute high. So short, 5-minute low. A better short entry would have been to short the retest and breakdown, trigger down after a failure to make a higher high. Okay, target, gap fill. Gap fill achieved right here. Okay, now another way that you could have traded this was the SMH. Which, by the way, was a great trade, which I still managed to make a mess up. I got stopped out on the SMH because I got in too low. And I ended up putting my stop too tight. So on the SMH, we had a flat open. So on the flat open, if I followed my own Michael DeGioia rules, you got to give it 30 minutes. Okay, so the 30-minute rule applies. Okay, so let's look at the 5-minute chart on the SMH. Today is the 23rd. So here is the first 5-minute bar right there. Okay, 5-minute bar. Got to give it 30 minutes. So you mark off the 30-minute high. And the 30-minute low. Okay, the 5-minute low break. So I shorted the 5-minute low break. Okay, got stopped out at the 5-minute high break. Okay, took it long for a scalp. Okay, but then did not reshort it when it crossed back down. Now the reason that happened is because we had a daily range. It didn't act off of this resistance. It ended up acting off of daily resistance. Remember that importance of the daily chart. And then, of course, it traded down for the rest of the day and closed near the lows. Okay? Now, this chart, by the way, looks, the play on this is that this should continue to go down on the daily to make new lows, lower lows. It's got a lot of clear air on the daily chart. I'm not at T. Nope, that's not it. All right, so SMH. Intel was a good one. Very, very nice chart on Intel for a gap up into resistance, gap fade. Not a great gap and go, but certainly a nice gap fade. Great example of a stock that had a big day yesterday was SSYS. Flat open. Give it 30 minutes. Right? This is the first 5-minute bar. Let's just go for 30-minute bars just so you can see one top bar. There was the 30-minute bar. Breaks the 30-minute low. Retraces the entire prior day. Great example of a 30-minute play with a flat open. Okay, see how it completely evaporates the prior day. And why did that occur? Big green day up, potential for a big red day down. Great example on Facebook. We closed near the lows. We gap up. We fade the gap. Break the 5-minute high. Continue higher. Pull back. Low, higher low, higher low. Any pullback is buyable. All right, guys. So I've given you a lot of examples. Hopefully you learned something. Hopefully you want to learn to trade gaps with me. Anyone who signs up for the Affinity Gap class gets a 1-month access to the Affinity Legends of Wall Street trading room where we trade gaps every day. We mark up and make a whiteboard just like this one. I'm just going to bring up the whiteboard from today. So this here is what our whiteboard looks like. Okay. And each day we had a couple of different stocks. We had RAD, which was a fade watch. That was from a couple of days ago. We had CTXS, Potash, Bud. Bud was a good gap and go. On the short side, we had Lennar, okay, which was a gap and go that then turned into a gap fade. Right? Gap fade was a check mark as part of the gap fade. So every day we give you a list of stocks that are gapping up, gapping down, some day trading ideas, as well as some swing trading ideas. And then obviously some core trading ideas for those of you who play a little longer. We put our earnings plays down here. Okay, generally speaking, if the stock is reporting before the open, it'll be below that blue line. And if it's reporting before the open, it'll be above the blue line. If it's reporting after the close, it'll be below the blue line. So depending on when it's reporting its earnings, we'll know to watch it either for that day or for the gap. If it's before the open, it'll generally gap that day in the pre-market. If it's after the close, it'll cause that stock to potentially do an earnings run, which is more of a day trading technique. All right, so hopefully, guys, this was a great introduction to trading and fading gaps. I look forward to seeing you in one of our upcoming classes. Usually after this free workshop presentation, we do a gap class on a Sunday. That way we can start trading and fading gaps that coming Monday. Monday is not a great day to trade and fade gaps because we use Monday as a gauge for the rest of the week. So the best days to trade and fade gaps are Tuesday, Wednesday, Thursday. Fridays sometimes don't tend to be too good. And but again, best days to trade and fade gaps are Tuesday to Thursday. We take it easy on we take it real easy on Mondays because we don't want to start our week in a hole. All right, guys, I hope that was helpful to you all. Look forward to seeing you this coming Sunday. Bye, everybody.